Welcome to another video from Insurance Domain Training Center. In this Quick Bite series episode, we explore a fascinating question. How does a small island nation with a population of just 6 million generate over 11 billion Singapore dollars in general insurance premiums? Discover the dual-engine model that powers Singapore's insurance market, the Domestic Singapore Insurance Fund, SIF, and the Offshore Insurance Fund, OIF. Learn how strong regulation, the RBC2 framework, global reinsurance activity, digital innovation, and InsurTech initiatives have transformed Singapore into one of Asia-Pacific's leading insurance hubs. Let us dive in. Look at Singapore. It is a geographically constrained island nation with a population of barely 6 million people. By all standard economic logic, its domestic insurance market should be proportionally small. Yet, in 2025, the country generated an incredible 11.2 billion Singapore dollars in general insurance premiums. If those premiums came solely from covering local cars, homes, and medical plans, the math simply wouldn't work. A population of 6 million cannot generate that massive volume of risk transfer on its own. The solution lies in a structural mechanism engineered by the Monetary Authority of Singapore. They legally divided the market into two distinct capital pools. The Singapore Insurance Fund or CIF, which handles domestic policies, and the Offshore Insurance Fund, the OIF. This deliberate separation is the engine room of the market, allowing a geographically constrained nation to build the capacity to take on risks from across the Asia-Pacific region. This table breaks down Singapore's domestic gross written premiums. If we focus on the baseline data from the FY 2024 column, we can trace the trajectory that led the local segment to surge past the $6 billion threshold in 2025. But that $6 billion is fought over in an incredibly saturated arena. Legacy players maintain a tight grip, controlling over 75% of domestic premiums. Referencing the market share column, we see this battleground is heavily concentrated in motor, health, and property insurance. Insurers face severe structural headwinds to maintain profitability in these lines. Double-digit medical inflation is driving up health payouts. While property insurance payouts have spiked 60% recently, a crisis triggered by a surge in large-scale commercial fires. To survive these escalating physical claims, the old guard is changing how they sell. Legacy insurers are steadily retreating from traditional face-to-face agency networks, shifting aggressively toward digital direct channels. Bypassing the middleman compresses acquisition costs. Surviving the domestic SIF engine now requires companies to offset their rising physical payouts with ruthless digital efficiency and strict expense management. That leaves the remaining $5.1 billion in premium inflows. To understand where this originates, we must zoom out to the Offshore Insurance Fund. Global reinsurers set up base in Singapore not to insure the island, but to underwrite massive regional risks. They cover complex multinational projects like Asian infrastructure development, global marine transit, and high-stakes commercial casualty lines. Convincing international corporations to park billions of dollars of risk here requires immense global trust. That trust is engineered by the Monetary Authority of Singapore. MAZ governs the market using the Risk-Based Capital to Framework or RBC2. This strict regulatory code requires insurers to continuously balance volatile risk weights against mandatory capital reserves. You might expect this to drive away foreign capital, but mathematically guaranteeing resources to pay claims provides absolute certainty. The strict regulatory oversight acts as a premium product in its own right. It serves as a magnet, converting the unpredictable economic risks of the region into guaranteed steady premium inflows. While both the domestic and offshore engines are currently expanding, the legacy players running them face intense pressure to modernize exactly how they calculate and price risk. To facilitate this modernization, MAS operates an innovation sandbox. This regulatory mechanism allows nimble insurtech startups to safely test disruptive business models without violating the strict rules of the RBC2 ecosystem. Inside this sandbox, tech companies deploy embedded APIs, real-time vehicle telematics, and generative AI tools to rapidly dismantle the manual processes of legacy markets. The financial advantage here is speed and scale. By integrating directly into e-commerce checkouts or vehicle software, these platforms eliminate onboarding friction and entirely bypass traditional distribution bottlenecks. Singapore's regulatory framework demonstrates how a small nation can anchor a regional insurance market by prioritizing solvency and digital integration over raw geographic scale.
Thank you for watching the Quick Bite series from www.inzu.com. Please like and subscribe to our videos for you to get notification when we upload new videos.